but also the return of a lot of markers which indicate that we might be in for a volatile last quarter of 2021.
Indeed, and this is fortunately turned out to be a fantastic lineup again for JPMorgan. This is the sixth iteration of our conference. Like last year, we are all virtual this year as well. And despite the Zoom fatigue, despite the overabundance of content, we have over 75 corporates, 75 speakers, including government speakers, policymakers, key industry leaders, and over 750 participants from the investing community as well. So a great 4-day lineup, even if I say it myself, and we are very encouraged by the quality of the content that we've been able to line up for these 4 days, I beg your pardon. And like you say, Neeraj, this is, as always with the equity market, a very interesting time, particularly so now, given the Fed meet, given more so the uncertainties on the economic situation in India and everywhere in the world, right? Generally, the economy kind of straight lines a bit, but this time around, visibility into what activity might be is lower. So getting these people on, getting the interactions going, I think will be very useful for our investor community.
Sure. Sanjay, what have you tried to build the central theme of this construct towards? There's this whole argument of value versus growth, and will value come back? There's a lot of argument around whether the fund flows will continue to drive, or will we have a big slide down because of taper tantrum, etc. What is the central theme out here, if there is one? And what is your central message, your individual central message to a lot of global investors who might be looking for some hand-holding and opinion around what the next few months could hold in store for Indian markets?
Right. So, Neeraj, there are two fundamental questions in investing at the moment, I think. One, of course, is the growth or economic outlook, and that is where the conference is centered. We've themed it as the growth imperative for India. That's the title of our summit this year. And that is where you can have a lot of debate on what really the economy holds for us in the next 3 quarters, the next 3 years, and the next 10 years and thereon. So there are multiple time frames, and you can have intelligent conversations or a very lively debate on the outlook for various themes and structural changes in India. The second fundamental question, Neeraj, is the market and investing question, which I would argue, and to your question on what I personally think, there are a lot of returns that have been made on a falling cost of capital. This sounds like a very boring answer, but it is the quantitatively correct answer to my mind, that since the GFC, it is the falling cost of capital, the abundance in liquidity everywhere in the world that seems to have driven a majority of the returns for equities. Seems to continue at the moment, which is why the stance taken by central banks over the next few weeks and thereafter will be very important to determining equity returns. Our year ahead piece in January, Neeraj, if I may point to it, was titled The Icarus Trade. Right? Icarus, the Greek mythological character who has wings of wax and flies towards the sun, rises as high as he can, and then collapses under the heat. Right? So that is where we think the market is today, continues to fly higher based on liquidity until that liquidity stops.
But okay, and Sanjay, I have to admit, this has been a central feature on our Talking Point show now for the last few weeks. The only place where respondents differ significantly, if you will, is the ferocity of the fall, depending on how closer to the sun is the market, and the subsequent rise, if you will. Now, where are you on this argument? One, presumably, even if we were to presume that due to taper tantrums, due to valuations, etc., there might be a corrective move. Will it be a short, swift one like the ones that have been in the last 18 months? Or would you reckon this time around can be different?
Well, frankly, Neeraj, this is an imponderable, right? And the only way we can think about it is to think about the various scenarios of central bank action. If central banks say that liquidity injections go to zero, so that the asset size or the balance sheet size of central banks remains static, then you should not see a very large correction in asset prices. Right? You may see a diminishing in incremental return, but you shouldn't see a very large correction. However, if central banks are forced to start tightening liquidity, pulling back, let's say, supply of money from the markets, then you can imagine scenarios where asset prices can fall meaningfully. That is not my base case, right? Economically, I don't see or I think it's very low probability that central banks will be forced to tighten dramatically in the current economic situation. So yes, you may kind of get to a more stable asset price environment, but I don't really, at least in my base case, don't really anticipate significant correction.
Okay. And Sanjay, would the nature of over the next 18 months, would the nature of the participants from, if there is a correction, and from that correction, if we were to rise higher because of led by economic growth, etc., would the nature of the participants change? Again, a fair degree of argument currently, as has always been the case maybe, but more so currently, because growth stocks are so valued primely, that the nature of the components would change, and themes naturally change, but the basic nature of value versus growth will change for the next 18 months. Would you second that, or not quite?
I'm not so sure that will happen. I would love for that to happen, Neeraj, because we've all been trained in colleges on DCFs and capitalizing asset pricing models. That doesn't seem to be working at the moment, at least in the traditional sense. If you go back in history and look at investing from 1970 to 2010, value in total returns has always outperformed growth, right? Apart from brief periods of volatility. It is only post the GFC that you see sustained growth outperformance. And again, goes back to the original point I was making, that it is the cost of capital that drives these valuations or these styles differently, right? If you think of equities as a cash flow stream, a growth equity has a higher duration than value. That is why when cost of capital falls, growth does better than value. So it makes complete arithmetic sense in a way. And if you think of it that way, only environment or only reason why value will start outperforming growth is if the cost of capital starts to rise. Okay, then duration will get sold off or growth equities will get sold off. And apart from little bit of normalization, I don't think global economy is in a place where you'll see significant increases in cost of capital for the next few years.
Okay, so if that argument is settled, Sanjay, may I ask you about I'll divide the remaining part of our conversation into two. One is where do you think India stands vis-a-vis some of its not competition, but the peers within the EM or the Asian Pac, considering that if there were to be some bit of a liquidity pullback, then the EMs and the Asia Pac, which is traditionally considered more risky, might get impacted a lot more. The converse argument that, of course, is that US valuations are so sky high that if the US starts to falter, then the developed markets too get impacted. What's your sense around this argument?
So first, that premise I think is entirely correct, that global correlations are very strong. Decoupling is very rare. In the last few months, India has outperformed EM about 25%, but I would argue that's largely to do with North Asia specific issues, and not because India is looking much better than the rest of EM trajectory-wise, right? So decoupling is rare. So if either EM paper tantrum happens or the US multiples start to correct, then India will also face that same headwind. Now, there are two other arguments, right? If you do see taper tantrum, India, at least from a currency perspective, is reasonably well placed because the RBI over the last 2 years has built significant amount of reserves. So the currency is more defensible now, and even if dollar liquidity were to tighten, at least in total dollar returns, India should not disappoint EM investors, should not do worse than other EM countries. So that way, it is reasonably well placed in the short term. I think the debate, Neeraj, for investors or EM investors in the longer term is India's growth potential over the next 7, 8, 10 years. And that's when you get into questions on the demographic dividend, the structural urbanization, the reforms that have been conducted and the benefits of that, the use of technology in the country, and this whole environment or this whole vision that India goes from a $2,000 something per capita to a $4,000 capital or thereafter, and therefore the increase in the total consumer pie in India. And that is the excitement for longer term investors. That is the reason I think India trades at a significant premium to other emerging market countries, because that growth is considered a little bit more assured in India, and therefore people are willing to pay up a little bit.
Interesting. Sanjay, you would have thought through what your central message around themes that could work near term and themes that could work medium term would be to the set of investors, because I'm sure your opinion is sought after a lot by the participants here. What's your sense near term, and more importantly, Are there themes? Are there government moves? Are there just the normal measures of Easternization, China plus one, etc., which is leading you to believe that there are some themes which have a more structural 3, 4, 5 year growth story, and you are compelled to present them within your top recommendation list, so to say, in terms of the themes?
So, Neeraj, that question can have an hour-long answer, frankly, and we've done a lot of work highlighting the structural positives in India. Let me try and summarize in a few minutes now. We are confident that India will deliver steady growth through a variety of endogenous processes that are happening in the country. So yes, people focus a lot on the China plus one, the shift in manufacturing, but there has been steady growth in India on a lot of parameters, irrespective of the shift. The shift will probably add a little bit of beta to growth if it does, but the core growth is still very intact in India. And we've argued that this happens through a process of transfer of labor and transfer of labor from agriculture to services or manufacturing in India, largely to services in India. And this is because agricultural productivity is always very low everywhere in the world. And when you shift these people to manufacturing or to cities, that productivity output per capita goes up a lot. You look at 75 years of Indian history, this works like clockwork. There's a lot of headroom for this to happen in India still. And our argument is that over the next 10 years, you can with great confidence imagine that India's standards of living will only continue to rise. Okay, and we can take that in detail and why we think that assurance is high. However, what this means, Neeraj, that when you have this great pie of demand or consumption in India growing, then the only variable for a company to succeed is execution. So for my longer term investors, the theme that we tried to we put it in this way, that look, you should buy domestic facing businesses, but the evaluation criteria should be execution of management, the execution of a company to capture the growth in its addressable market locally. Right? So domestic facing businesses, good quality management, good execution, brands, company strategies, those are the filtering criteria. I am slightly less fussed about which sector within the consumer space or the financial space I'm chasing. It needs to be domestic facing, it needs to be quality company. The shorter term question, Neeraj, is a little bit more complex to my mind. While everybody believes that India post-COVID gets back into super strong growth, 8%, 9%, at least that's what the earnings forecast suggests, we are not so confident of that. So our view is that the economy today is very two-faced. There is a section of society whose savings have gone up, who have this pent-up demand and will come through and are already coming through as the economy reopens. But the lower end, where the masses are, where the bigger population chunk is, has lost savings and has lost income during COVID. We have done a lot of surveys proprietary surveys over the last year and a half, and our surveys confirm this assertion that consumer confidence or risk appetite in the lower end of India is actually pretty poor. So we do not expect that upon reopening, you're going to see super strong activity levels and super strong growth. Therefore, the question lies, what drives growth in December, March, June next year? And there's only one thing happening in the economy, or one major thing in the short term, Neeraj, which is the monetary stimulus. The abundance of liquidity, the collapse in interest rates, that this can be very powerful in driving demand. So in the near term, we are actually very positive on a relative basis, of course, on the rate sensitive sectors, the financials, autos, depending upon timing, if you want to time it, and real estate. The rate sensitives are what we like for a near term play, whereas longer term, we'd like anything that focuses on Indian consumption.
Last couple of questions. One is just a quick counter check, Sanjay. A lot of people argue that the lower end of the spectrum demand getting, well, say not coming back in full gusto will not anyway make a material difference to the consumption patterns of India, simply because it is the top 5%, 10% which drives the discretionary demand any which ways. And if that income is strong and if liberties open up, then that will bring about a consumption spurt. You don't second that?
No, so just to imagine, Neeraj, that India is segregated into two distinct buckets, okay, and that these buckets don't interact with each other in any way is not correct to my mind. You can argue that the incomes of the top bucket are derived from the activity of the lower bucket as well. there is a lot of interconnect, and it is difficult to be precise in modeling it. But I would assume that arguing that these two are entirely separated does not make sense.
Fair call. My final question, Sanjay, I know we're out of time, but you mentioned this point, and I want you to elaborate a bit on that. The assurance of earnings activity in specific themes related to consumption or otherwise, which you just alluded to, that we can probably expand on that. Would love you to expand on that, and then we can wrap up the conversation.
Right. So the concept, Neeraj, is that look, India may not emulate the strong growth of China, the investment-led growth of China, because there are a variety of reasons. One of them being that we are a bottom-up country where local governments have far more say in activity levels, and for right reasons as well, I would argue. But what that means is that we will have possibly slower growth than China, but steady growth over the medium term, right? So you will still get that compounding effect in India as well. And at least in an EM context, that is now a rarity. So there are not too many countries of this size where you can argue that you have this assurance of growth. So when India goes from, let's say, $2,000 per capita to 4,000 in 28 or 2030 or whatever, you'll get two effects. One is the expansion in the pie itself. So you'll have more consumption of everything. But you'll also have J-curve effects in many commodities, where at a tipping point, you will have sudden accelerations in category growth. You will see growth in newer consumption patterns along the lines of that per capita GDP growth. So that is where I think bottom-up P&L modeling, bottom-up company analysis needs to be focused on. What are those categories where I can A, get the expansion of the market, B, where I can get some J-curve effect as income start to grow, right? And that's what I think investors at these valuations particularly need to look at. Easier said than done, frankly, Neeraj, but I think that's where effort should go.
Okay, and I'm sure some of it has already happened at your end, but during the course of the next 6 months, we'll try and get some conversations out of your stable, Sanjay, wherein we can dwell a little bit more on this. But for now, I understand you have a busy day, so we'll leave you with the conference. Thank you so much for joining in, and all the best with the next 4 days.
Thank you very much, Neeraj. It was good to be on.
Yep, and thank you for spending time. And viewers, thanks for tuning into this conversation.